and welcome to Money Beat. I'm Paul Vigna. Breaking news this morning, NATO says the use of chemical weapons in Syria cannot go unanswered, and those using them must be held accountable. Also this morning, the UK said it would ask the UN for action on Syria, and the United States has signaled they must respond quickly to Syria's alleged use of chemical weapons. Remember, Syria keeps insisting that they were not the ones responsible for those attacks. These mounting tensions are also raising the hackles in the oil market. You can see oil share has been rising sharply. Heard on the Street editor Liam Denning joins us to just talk about this one. So, I mean, it seems like you always see this in the oil market, right? A sort of knee-jerk reaction to something happening in the Middle East.
That's right.
And certainly that's part of it, but do you think that's the whole story?
No, not at all. I think there's definitely a premium in there because of what's going on in Syria. I mean, Syria itself, if you isolate it, doesn't really matter to the oil markets.
Right. I mean, it's not a big oil producer,
No,
right?
It used to produce maybe 350,000 barrels a day. It's probably producing 50,000 barrels or less now that the war is on. I think what it is, it's that usual kind of vague fear of a wider confrontation. Right. Syria is a key Iranian ally. Yes. It's right next door to Iraq. We've obviously got problems in Egypt. Libya is still rather unstable. I think what's really happening is that there are existing disruptions to oil supply at the moment. There are strikes in Libya at key export facilities. That's probably taken about 1 million barrels a day off the market, which is quite sizable. You've got ongoing problems in places like Nigeria, Yemen, Iraq itself. It seems like every time they open a pipeline, it gets bombed. Yeah. But I think what investors buying into this current rally may be missing is that, you know, there are some wider forces going on at the moment in the oil market which are actually pushing the other way. Now, obviously, if you do get a very wide conflict in the Middle East, then yeah, all bets are off. I mean, in particular, if Iran was to do something crazy, Straits of Hormuz, you know, that would definitely be a big issue. But why Iran would choose to do that, given the destruction that would invite down on the regime there, is unclear to me. I think a couple of things to watch. One is the US in some ways has kind of a free hand here in terms of taking action, at least from the perspective of disruption to oil markets.
To oil supplies. Because
we're using less oil than we used to, and because of surging domestic production, oil inventories in the US are off the charts relative to net imports, particularly if you factor out Canadian imports, which, let's face it, there's not much chance of those being disrupted. And I think the other thing to watch is that the wider demand picture still isn't that great. Essentially, the oil market is relying on China at the moment, as it has done for the past 5 years. China has accounted for about 2/3 of incremental oil demand. And the fact is that although we had pretty decent oil import figures for July, most of that oil, or a large part of that oil, is actually probably destined for storage. And the import picture in China isn't actually that great. Chinese imports of oil actually peaked last year. We're not really seeing the growth.
So we pulled up the chart of oil prices. They're up around 110, the benchmark WTI, the West Texas Intermediate, 109.99. It just, how much further up can that go?
Well, that depends on...
I ask the hard questions, Liam.
Okay, well, look, it depends on a couple of things. Look, if Straits of Hormuz get blocked, you're probably going to see oil go to 200. I mean, who knows where the ceiling is? I think the thing to think about is we've been here before in terms of 2008. We saw oil get up to about 145. It reached a point where people stopped using it on the margin. They found new ways to try and curb consumption. Now, one way is you just have a recession, which kind of curbs it for you. But the other way is we start driving more efficient cars. We start changing the way we live. Estimates for what that level is kind of vary. One that I've seen from an analyst I trust is around $125. We're very close to that. Wow. So once it starts going...
That's actually pretty high.
But we're not that far off.
Right.
Once it gets to that level, you start eating into long-term demand. So yes, you can have a spike. And one thing to keep an eye on is the stocks of oil producers. Believe it or not, they don't actually like where oil prices are right now. Because yes, it helps in the short term, it boosts their cash flow, but ultimately it's eroding the demand for their product.
Sure.
What you really want is a demand-led recovery in oil prices, not one that's fueled by supply shocks, because eventually they go away, and when they go away, the demand that was there has also gone away because people have found a way to get around using oil.
All right, Liam Denning, good stuff as always. Thank you
Thanks
very
a
much.
lot.